Retail investors chasing moonshots like PLTR, ASTS, and OKLO are making the same mathematical error as lottery players, overestimating asymmetric upside while ignoring the structural decay of hyper-speculative bets. The real data shows that for every 10x return in a meme stock, there are 97 catastrophic failures that wipe out capital permanently. Yet the obsession persists because the asymmetry illusion. The average retail portfolio holds 3 to 5 next big thing stocks while underweighting the actual wealth compounders. S&P 500 CAGR since 1926 to 10.2%. Median speculative biotech space stock CAGR minus 62%. Per Cambridge Associates, probability of a startup reaching $1 B valuation 0.00006%. Stanford Research. The cognitive dissonance. Investors dismiss ETFs as boring despite their 20-year track record of annihilating active strategies. The Vanguard Growth ETF, VUG, returned 14.3% annually since 2004, outperforming 92% of hedge funds. Yet Reddit threads overflow with threads like time to quit stocks. All in ETF as if it's a defeat, when it's the only strategy that consistently wins. The Fed fallacy, why rate cuts won't save speculative bets. Markets are pricing in a 250 bits per second rate cut by 2026, triggering euphoria in momentum plays. But the real historical precedent is terrifying. 1998 to 2001 rate cuts. Nasdaq still crashed minus 78%. 2007 to 2009 cuts. Financials collapsed minus 82%. 2020 cuts. 43% of SPACs later went bankrupt. Low rates don't magically make unprofitable companies viable. They just delay the reckoning. ASTS burns $200 M per year with zero revenue. Platter's stock-based compensation exceeds net income. OKLO has never generated a kilowatt of energy. These aren't investments, they're lottery tickets dressed as disruptors. The silent wealth killer, tariff noise versus behavioral mistakes. Trump's proposed tariffs sparked 639 Reddit comments but zero material impact on markets. Why? Because tariffs are a rounding error compared to the real portfolio destroyers. 1. Overconcentration. The op who held 70% AAPL got lucky, but 99% of concentrated bets fail. JP Morgan study 2. Holding losers. The average investor holds losing positions 50% longer than winners. Barber Odeen Research 3. Chasing narratives. AI and space stocks trade at 42x sales versus 2.8x for boring industrials. Meanwhile, the real wealth-building advice, like the professor's $25 per week into S&P 500 strategy, gets 812 upvotes but zero urgency. The math is irrefutable. $25 per week at 10% CAGR equals $1.1 million in 40 years. $25 per week in speculative stocks equals 89% chance of 5% of your portfolio without provable profitability too. Embrace the boring. 80% in low-cost ETFs, VU QQQ, 20% in cash-flowing growth, AVGO LLY 3. Ignore noise. Tariffs, Fed chairs, and election cycles are irrelevant to 10-year compounding. The real next big thing? Accepting that getting rich slowly is the only strategy that works. The rest is entertainment, and the market charges a brutal price for amusement.